morning. Welcome to the investment meeting of the Teachers Retirement Board for December 4th, 2025. I'll start by calling the roll. Kevin Liu.
Kevin Liu. Mayor Adams, present.
Thomas Brown.
Present. Good morning, Patricia.
Good morning. Marjorie Faulkner. John Dorsa.
John Dorsa, designated to control Brad Lane, present.
Victoria Lee.
You mean?
Christina McGrath.
Good morning, Tricia, present.
Good morning. We have a quorum, and I will turn it over to the chair.
Good morning, everybody. And we start with the public agenda passport funds, and I think Amanda's going to take that.
Morning, Tom. I think Gina from our team hopefully can share her screen. We are going to start with the quick update on the final numbers for the third quarter. We had previously shared a September flash report, but just wanted to update the board on the results through the end of the third quarter. It was a strong quarter, continuation of what has been a very strong year. The passport funds closed out the quarter at $23.3 billion in assets, up from $21.2 to start the year. So you've seen some good growth among the passport funds. 90% of those assets are held within the diversified equity fund, the top fund shown here on the slide. Gina, it looks like there's a window covering your screen. Great, thank you. Can you flip to the September results though, please? The diversified equity fund for the quarter returned close to 7%, has trailed its benchmark. It has continued to be a somewhat challenging environment for active managers really across asset classes. So you do see the active sleeves within both the US equity and international equity sleeves have trailed their benchmarks. The balanced fund for the quarter was up 3.16%. The international equity fund up over 5%. The sustainable equity fund being the laggard for the quarter at up just under 1%. And this is not reflective of the changes that began to go into effect in October. And then your passive funds at the bottom of the slide, the US equity index up 8% for the quarter, and the international equity index up 6.5%. Any questions on 3Q?
Any questions for Amanda? Great, we can move on to the total passport funds. Thank you, Amanda.
Gina, are you able to share the October flash?
Yeah, give me 1 second. Sorry.
Thank you. So the month of October, we saw a little bit of volatility to start the month. Again, renewed threats of increased tariffs to China. Trade policy has been one of the biggest drivers of volatility that we've seen in calendar year 2025. But ultimately, strong earnings results did end up landing us in mostly positive territory for the month of October, really across the board here. So you ended the month up even further in terms of assets for the passport fund. So closing out October at $23.6 billion in total assets, with the diversified equity fund ending the month up 1.8%. The balanced fund up about 0.75%. The international equity fund up 1.4%. Sustainable equity fund up 1.2%. And the passive funds at the bottom of the slide, US being up 2.1%, and the international equity index up 1.5% for the month of October. All right, so if there's not any questions on October, I'll flip over to the November benchmark report. Okay, sorry, I have a problem here.
Some water, Amanda?
I have, it's not helping. Yeah, you want to do November?
Sure. So
November was a month where we did see a little bit more market volatility. There were some notable down days toward the latter part of the month, but we had a pretty strong early part of the month in equity markets. The November report is also convened, and on screen you can see a modest positive return of about 0.25% through broad U.S. equity markets. Non-U.S. equity markets were closer to flat, but still positive. For the month overall, where we saw some negative performance was really outside of developed markets. In the emerging markets, you can see that line item toward the middle of the page. The emerging market index was down about 2.4% during the month. Still a very, very strong environment for all of these benchmarks so far calendar year to date, and I would say also for the fiscal year to date. And then just a little bit more notably, as the composition of the sustainable equity fund continues to evolve, you'll begin to see reference to both U.S. and non-U.S., or I should say global markets, as part of the sustainable sustainable equity fund. I'll just pause there and see if there's any questions.
Any questions from Michael or Armando? Great, thank you. We move on to the public agenda pension fund, and I think Dan Haas is going to do that. You can sit up here, Dan. Okay, great. You see. Thank you. Welcome.
Thank you very much. It's a pleasure to be in front of you again. Same here. Well, good morning, everybody, and again, thanks for having me. My name is Dan Haas. I'm serving a few hats here, but kind of pinch hitting for Francesco and in place of Steve. Just gonna give you your quarterly kind of performance update and a little bit of market commentary around that. Very similar to what you've seen before. As we kind of run into this, again, channeling my inner Steve Meyer here. A few headlines for you that kind of set the stage for some of the things that we're kind of leaning into here. And the theme is just this: it's mixed signals, right? We have a very strong economy. The S&P closed last night, about 1% off of its all-time highs, which we realized back in October. Businesses have strong fundamentals. We have great earnings. There's great earnings growth. And it's fueling quite a lot of growth in the economy. On the other hand, markets are top heavy, right? Think of the Magnificent Seven. If you think of the top 10 companies in the S&P, they account for something like 30% of the index earnings. So it feels peaky, right? And as we look ahead, you're looking at other signals from the economy, and we see inflation running a little bit higher than target persistently. We see unemployment slowly ticking up over time, and there's some other signs of stresses in the job market that we'll kind of get into in the following slides. So that creates a lot of uncertainty among policymakers, and you see that kind of playing out in the terms of the politicization of the Fed, pressure from policymakers to take a specific direction, even though they're not necessarily on the Board of Governors. You have unprecedented dissent among the FOMC. So they disagree on policy direction because, again, the road forward is a little less clear than it has been in the past. We kind of jump into some of our charts. A little shout out to Bloomberg here. These charts will look very familiar. We talked about inflation a little bit. Again, CPI, we expect an update. This is through August, but in September, we expect those numbers to be out on the 18th of this month. And then PCE, that yellow line, we see that tomorrow, and they think that's gonna pop up to about 2.8%. At any rate, as we look at measures of inflation, you see it kind of, again, above the 2% target consistently, and we'll just see how that runs. As we kind of move on to the next slide for unemployment, here we're running at 4.4% headline unemployment. That's within the range of what you'd call the natural rate of unemployment or full employment, which is somewhere between 4 and 5%. Recently, it's been kind of steadily ticking up over the past year and a half or so, but we're at 4.4%, which is not really a signal one way or the other as to the direction of that particular metric. However, that green line there, that's actually a new series. In the past, I showed you kind of the headline labor participation rate, which is, prints something in the 62% range. And we're switching that over now to the prime age workforce. So those are workers ages 25 to 54 years old. And that shows you a slightly different metric. That metric is actually very near its all-time high. It hit 84.3% back in 1997. Here we're at 83.7%. That's a slightly different signal than what you'd see for the headline labor participation rate, which is much lower than its all-time high. This suggests that at least among this cohort of workers, the prime age workers, we're showing a bit of capacity constraint there. And depending on which way you want to look at the coin, that could portend some headwinds in terms of inflationary pressure from the labor market, or it could mean that we've got a little more dry powder among the non-traditional, the non-prime age working force. Time will tell how that plays out. As we kind of move on to the next one, again, GDP growth for major developed economies. We don't need to get too much into this because there's only a few insights to kind of pull from this particular metric. I'll note here, due to the government shutdown, the U.S. print is back to June of this year. We expect a September update on the 18th of this month. But if you do look at it, you notice that the U.S., that red plot, is a little bit ahead of of our industrialized peers. You see China printing at 4.8%. However, Bank of England and the EU are slightly lower than the U.S. U.S. had relatively strong growth among the developed peers. The next data point I mentioned on the 18th, we think this will be a bit higher. The Atlanta Fed, for instance, they posted GDP now estimate that's showing about a 3.9% level for September. Other sources, again, I'm pulling this from the Atlanta Fed, they call it blue chip estimates. It's potentially slightly lower print, but still in the 3% range. So we expect that to grow a little bit as again, the last quarter was a bit of a hangover from spending early in the summer in relation to tariffs, and we think it's just going to come back up a little bit more. Moving on to target rates and Fed rates. Again, with this, we're comparing the U.S. to, again, other major developed markets. You see that along with Bank of England and the ECB, we're in the midst of a rate cutting cycle. We stand at a 4% target rate in the United States, and there's a very high likelihood, about a 90% chance that we'll see another 25 basis point cut next week on the 10th. This is again sort of a reaction to the aggressive rate hike cycle that we saw in response to inflationary pressures. As you see, a sort of rotating out of concerns for inflation and more into economic growth and employment, we're starting to cut rates along with our industrialized peers. And of course, down at the bottom, Japan, they're actually in the midst of a hike cycle. They have kind of unique market pressures where they sustain a long period of deflation or very low inflation, and they're starting to normalize a little bit more, so they're able to raise rates a little more similarly. Next slide, our treasury yields. Story here really is one of normalization. There are two things that you see kind of floating here. If you look at that gray line, the bottom line, that's what our rates curve was back in 2020, 5 years ago. And you can see the base rates were quite low. Early maturity government debt at that point was effectively free, and that went up to about 1.5% or so for the 30-year debt. But it was a positively sloping curve. You saw some term premium in there. If you fast forward to today, the red line, you can see that our base rates are quite higher. So we're getting compensated more for our fixed income investments to the tune of 4%. The other takeaway there, again, is just the positive slope of that curve. The fact that we're being compensated more for investing longer term than shorter term. And if we flip to the next slide, that's kind of a demonstration. This is a plot of what we call the 2s-10s curve, or the 2s-10s spread, rather. In the past, again, you can see that first half of that graph, that red line is a zero rate, meaning that there's you would have the exact same rate if you bought a 2-year treasury relative to a 10-year treasury. In the past, that rate was inverted where you'd receive more in yield for a 2-year treasury than a 10-year treasury. That used to be a signal, and maybe it still is, but for various technical reasons, it didn't pan out this time. But that used to be a signal of a kind of a harbinger of doom, right? Oh, we're going to be in a recession, typically from, when you see that, somewhere from 6 to 24 months. And that didn't come to pass on this past cycle. We had an inversion of about 2 years before earlier this year, where it's about a year ago, where it became positive, and now we have a 55 basis point positive spread between 2-year yields and 10-year yields. That's still a little bit below our long-term, kind of a long-term average, which is about 85 basis points, but definitely a sign of normalization in that space. So we move to the next slide. And this is just a quick snapshot of where our credit spreads are today. That bottom line is the investment grade spread. So that's the amount extra yield you would expect from investing in high grade in corporate debt relative to a risk-free treasury. And then the orange line above that is the same metric, but for high yield debt, for lower grade corporate debt. Headline for them is the same for both. We are near all-time lows for those, meaning that the market isn't demanding a whole lot of extra compensation for taking on the extra credit risk in these types of debt. And they're also significantly below this. I'm showing you the 25-year average here, significantly below that average as well. So again, it speaks to a benign market environment and the fact that people are investing. They have animal spirits. I will mention, just kind of wearing a risk hat here. You do see significant and extreme dislocation in times of stress in this space, right? When you see the spreads blow out, it happens suddenly and kind of extremely. That accounts for those spikes there, but it also recovers over time. The knock-on effect for our system is that you're cash rich, you're well diversified, and you can ride out these sorts of events. And then last slide for this section, market returns. There are a few things that we show here. And again, these are kind of index returns. Similar to what Amanda was talking about. Obviously, mine's lagged another month because we are monthly participants. But the thing that really stands out to me, if you look at the 3-year returns, right, particularly for equity markets, that's, if you look at the U.S. equity market, 24% year over year for each of the last 3 years. That translates into almost doubling your capital over 3 years in the U.S. space. That is an unprecedented, huge run-up. You see that consistently, in developed international and emerging markets. High yield has done quite well. And if you look to the right there, what the expected returns are. Last time we performed a strategic asset allocation for each of the systems, we took estimates from Goldman Sachs. We took estimates from other consultants. This is the average of those for these same asset classes. So you can see that when we set asset allocation and presented it to you, we weren't expecting this sort of performance, right? Long-term performance. There's an argument here for reversion to mean. There's an argument here for, there are certainly knock-on effects for how the estimates have progressed since that point in time. But something to keep in the back of our minds as we start thinking about the next strategic asset allocation exercise that I think comes with the new administration. We move to the next slide. Again, we'll just walk quickly through your performance overview for the third quarter. This is the snapshot I have here. It's kind of a lousy performance metric, but it really does kind of distill things. It can obviously be biased by the beginning and ending time frames, right? But over this particular 10-year period, if we put $1,000 down on a guaranteed 7% return, and we put $1,000 into the teacher's QPP portfolio and the fixed return portfolio, for that matter, you would see relative performance over time. This is just cumulative returns over that period of time. Today, at 7%, you'd be looking at something like $1,950, so a little under $2,000 in total value. Teachers' portfolio is around $2,300, so it's great performance. It's a wonderful metric. Again, not if you're technical, it's not a great performance metric, but it's a neat neat slide, I think, for just kind of framing the issue. Moving on to the next slide. Not much to talk about here. This is just your portfolio composition. As of the third quarter, you're about a quarter in U.S. equity. We're rebalancing. We meet weekly, obviously, to look at your active weights and take action. A lot of times, the tactical is raising cash to pay benefits or moving things around. But when you see particular sectors outperforming relative to others, we'll bring those back within a range, and we have fairly tight constraints on that. So we're never very far away from your adjusted strategic asset allocation. Again, your public equities are a little bit less than half the overall portfolio, 46%. Fixed income is about a third of it, and the rest is alternative. Moving on to the next slide. These are your plan returns as of the. Oh my goodness, I've got a terrible. The header there should say September 30th. Pardon me. But this is for your third quarter, so September 30th, 2025. Again, nothing unfamiliar for you here, but we're showing you the quarterly returns out to your 10-year returns. We're comparing it to your policy return, a public market equivalent of 65% public equities, 35% fixed income, and then the Tux universe, so your peers of large pension systems. Again, all positive returns. You tend to lag your policy return and the public market equivalent returns. Again, that's driven largely by the public market run-up that we've seen over the last several years. Right, that's driven so much return in that space that the fact that we've allocated to alternative investments like private equity that have public market benchmarks, you see us lagging a little bit. Not good or bad, it is what it is, right? A good result, nevertheless. I'm going to move into, there we go, strategy returns or returns at your strategy level. As we start looking at your equities, again, strong 3-year performance, green across the board. You see core fixed income at your 5-year, that's a slightly negative number, but again, that has more to do with structural market components, the expansion of the base rate over the past 5 years. Has dragged performance there a little bit, but still a good positive overall outcome. Moving into how these same strategies performed relative to benchmarks. Again, mixed bag here. You see nothing terribly extreme. You see the world ex-US, lagging fairly significantly over the 1-year period. Again, that is it's a combination of two things, right? We've made specific allocation decisions to sub asset groups. Right. So, for instance, in U.S., rather than being exposed only to the Russell 3000, we have specific allocations that go out to small cap growth, for instance. So you have some style components that work into those active returns. And then similarly, the rest of that would be attributed to how individual managers within those cohorts performed. Moving on to alternatives. Headline here. Again, great returns are positive across the board. Private equity, those returns are muted a bit just due to the structure of the secondary sale that was completed back in March. Real estate is still recovering from the COVID and the inflationary pressures that came after that in the 22 context. But again, a return to positive performance and probably fundamentals are improving. Something for Mr. Gluzak to discuss with you more in detail. And then infrastructure and alternative credit, again, consistent, positive, strong performance from each of those classes, which is good news. Showing you the same strategies on a relative basis. Obviously, what's jumping off the page there is the relative returns for private equity to that public market benchmark, the Russell 3000. Again, same metrics at play here, right? The Russell 3000 is driven by a relatively small cohort of largely IT companies, right? It plays into the Magnificent Seven, plays into the conversation you're hearing about AI bubbles, that sort of a thing. That's driven quite a lot of performance. Good or bad, it is what it is. Your private equity book accesses a slightly different sector of the economy, right? That's middle market buyout companies, if you're thinking very generally, which just perform differently. There are different pricing mechanisms at play for these asset classes, where your marks are marked by model as a matter of convention. Those models are often derived from metrics like cash flow and earnings growth and multiples, which tend to be more steady, so you don't see run-ups as quickly or sell-offs for that matter as quickly as you would in public markets, which are subject to the vagaries of the investing population. So that explains a lot of what's causing that difference. Again, strong performance out of infrastructure and alternative credit. This next slide here, actually one of my favorites, and I got to credit Ed Berman for conceptualizing it. Ed always wanted to equate volatility within your portfolio to expected returns, and that's a great way to frame it. Here, those bars represent the portfolio volatility for each of those strategies or the portfolio at large over a 3-month horizon, right? So within a standard deviation, or about 2/3 of the time, you could expect your actual returns to fall within those bands. And about 1/3 of the time, you'd expect it to run outside of those bands. So as we look at your third quarter performance, those are the plots that you see there, the yellow triangles. And you can see that, good news across the board, for the most part. Emerging markets equity fell a little bit outside of their band, but that's not unconscionable. It's just about 1/3 of the time that you'd expect that. But great news across the board, but it's not highly unusual, positive or negative. Moving into this last slide. Again, portfolio risk summary, something we've sort of discussed here in the past. And again, this table on the top left, it tries to distill your allocation decisions, right? We're comparing the allocation decision to that market portfolio, a 65% mix equities and 35% of Barclays Ag US fixed income, to your policy benchmark, and then to the portfolio that you have in ground today. If you look at the market portfolio again, we've got metrics kind of down that first column. The equity allocation, that's how much equity risk we're taking in each of the portfolios. Your interest rate and credit spread duration, again, that's a measure of interest rate sensitivity that you have. So price sensitivity to changes in interest rates or changes in spreads, as the case may be. And then some top line risk, what the risk, the predicted risk of the overall portfolio is, how much we can expect that risk to vary from its benchmark. That's your active risk, and then the beta to the S&P. So if we kind of work across the page, starting with the market portfolio, you have certain implications where your rate duration and your spread duration are 2.1%, 1.2% respectively. If you move over to the policy benchmark, so how you've actually allocated your portfolio as a matter of policy, you see those risks have declined a little bit. You take a little bit less rate and exposure risk as a matter of policy. You can see that the overall risk, the total risk of the portfolio, is down slightly, right, from 10.4% to 9.3%. And then we have a lower beta to the S&P. Right, 53 basis points as opposed to 60 basis points. So that's how your policy has been set. If you look at the portfolio on September 30th, again, we're a little bit lighter in equity. That has more to do with parking places for your alternative assets than anything. We tend to allocate a little bit more to fixed income for infrastructure and real estate parking places. But we've also taken slightly more interest rate and credit duration risk. The total portfolio risk is a little bit higher than the benchmark. Your active risk at 1.8%, again, that's the amount that you would expect the returns to deviate from benchmark returns. That's 1.8%, which is constrained to a fairly narrow band. We'll talk about that in a second, historically. And then your beta is 55 basis points. Again, lower than the public market portfolio, a little bit higher than your policy benchmark. Sure, John.
Sure. So I've seen this chart before, but I guess I just never realized. So the active risk is 10A, So does that just imply all the policy benchmarks are just the passive with no alterations to, no premiums on there or anything?
Yeah.
Like, what
Well, we-
strikes me is like the PE piece is just the 10% private equity. Is that just an index of, like on the bottom it says policy benchmark?
Yeah.
Is that just there's no premium on that benchmark?
Correct, yeah.
Okay.
From a
that's
risk
what I
perspective,
did.
yeah. Whether you measure the risk of the Russell 3000 with a 300 basis point kicker, like we have for liquidity purposes and as a matter of policy, or just the Russell 3000, the volatility is the same.
Gotcha.
Right.
Yeah.
Yeah. And the reason you don't see, we measure your active risk relative to the policy benchmark, just as a matter of course. So there is no metric really between the policy benchmark and the market portfolio.
Thanks for the clarification.
Of course, yeah. And then finally, the charts on the right there. Thanks, Wilfredo. Again, this is just a plot, a historical plot over the past 12 months of your total portfolio risk. Again, we're showing the orange line is your portfolio in ground. Policy benchmark is the plot just below it, and then the market portfolio is the plot just above it. You can see that they react similarly to market events. You see that you'll notice that in April, your risk popped up significantly. That's really sort of a response to the Liberation Day, the market response to Liberation Day announcements, where there's a lot of uncertainty around tariffs and what that would do to the economy at large. And then you see it kind of declining over time. You see similar patterns with the VIX and the move indices, the volatility indices that we tend to look at quite a bit. And then the bottom one is just your active risk. And again, that's just the amount that you could expect your returns to vary between the portfolio and the benchmark. And that's fairly tightly bound between 1.7 and 1.9 over the past 12 months, which is consistent with what we've seen in the past. I'll stop there. If you have any questions for...
Any questions for Dan? Well done. Chris, Steve, some competition there.
I would try that. He's a lot more eloquent than I am.
Well done. Thank you. Thank you.
Great, thanks.
Any other questions? Great. So I think that brings us to the conclusion of our public agenda. Do I hear a motion to go into executive session? So moved. It's been moved. Is there a second? It's been seconded. Any questions or comments? Questions? All those in favor of going into executive session, please say aye. Aye. Opposed, say nay. Abstentions? We're now in executive session. We are now back in public session. Wait for. Back to public session, and I believe we will have a readout from TRS's Priscilla Bailey.
Good morning, everyone. Hope
Hey,
everyone.
Priscilla.
Hello, how are you? Okay, for the executive agenda in the passport funds, there was a presentation for company inclusion to the investable universe. Consensus was reached and a resolution was passed. In the executive session of the pension fund, there was an update on preliminary performance. There was a domestic small cap growth presentation. Consensus was reached. This was followed by an emerging markets growth presentation. Consensus was reached. There were 2 private equity presentations. Consensus was reached on both. And finally, there were 3 real estate presentations, and consensus was reached on all 3. Details to be made available at the appropriate time. Thank you all.
Priscilla, thank you so much.
Thank you, sir.
Appreciate it. And I believe that brings us to the end of our public session. And as always, I thank Will, our recorder, and Adrian, our TRS tech. Thank you guys so much. Much appreciated. Any questions before we ask for a motion to adjourn? Therefore, I will entertain a motion to adjourn. So moved. So moved. Is it second? Sorry?
Second.
Oh, it has been said. Great. Heard it. Conversation, questions? All those in favor of adjourning, please say aye. Aye. Those opposed, say nay. We are adjourned. Thank you so much. That's to say happy holidays. Wow. Oh, squeeze that in, Will?
Yeah, well,
Could you squeeze in a happy
Squeeze in a happy holiday.